We're just about getting ready here, and we're just going to start here now. So I just want to make sure that you can hear me. So I'll look in the chat session if you can just let me know if I'm okay. All right, perfect. Okay. All right, so let's get going here. This is a webinar for SPX 70TE trades, and I'm going to be sharing with you different aspects of what I do and how I trade these. And I'm going to have real, not a live trade, but a trade that I've done, several times, and I use the process that I use, and you'll be getting a lot of information for what I do and how I manage those trades, and that way hopefully it'll have a lot of value for you. And so that's what we're going to do here. Okay. All right. So let's get started here now. Okay. So what can you expect? I'm going to show you how you can make consistent returns monthly based on margin capital at risk using 70TE high probability trades. Okay. So in this way, how will you learn? Okay. How to select the right strike prices, number one. Number two is detailed entry, exit, and stop loss criteria to maintain consistency. Number three, how to prevent large losses by managing a threatened trade, and how to know when to trade. The best time to widen spreads to gain an edge on the position, and how to trade consistently profitable. All right. Okay. So with that, I am going to ask you to stay with us to the end until we have a bonus here. So we're going to have a bonus, and so I think you're going to enjoy that one as well. All right. Okay. So let's talk about while you're here. Okay, so we have three reasons, right? Reason number one, you're interested in learning new strategies that will take your trading performance to the next level so that you can finally leave that 9-to-5 career behind. Number two is you've seen, heard about, read about others making money trading, and you know that you can do it too, but you're just not seeing the account grow fast enough based on your goals. And number three is you've tried different trading strategies that you thought, okay, this is it, only to discover that it's just not getting you to the place of consistent trading results. Okay, so this is kind of a journey for most traders. So with that, just a show of hands here, interested in learning new strategies? 1, 2, desire to see your account grow. Number 3, find the right strategy that provides consistent results consistently. So probably not the right wording, but that's what I'm saying. All right, good. Shirley, thanks. Done. Perfect. 3, 3, 2. Got it. 2 and 3. Yep. Okay, good, good, good. So I guess we're in the same place here. Okay, perfect. All right. So just want to let you know that I am a regular guy, and I was in the tech world for a long, long time, and then moved into finance, and really love what I did, and and ended up with credit spreads. And so we're going to talk a lot about credit spreads and what they do. But in this case, just to let you know, regular person, have a family, and that's my mom and dad. And that's a long time ago. It was an MBA program so that I was in. Okay, so with that, let's talk about mindset. Okay, mindset is really, really important as a trader. You really have to know, how to manage positions and how to manage losses and gains. So let's talk about imagining what you can feel and what you can do in trading. All right. So imagine what you can feel if most of your trades were winners month after month, and it would be confirmed by watching the size of your account grow at the same time. Also, becoming the trader that no longer takes large losses but consistently trades according to a proven trade plan. that is profitable over time, allowing you to grow your account month over month. So keep that in mind. All right, it's really, really important as a trader. Okay, so let's talk about credit spreads and what it is, all right, or what they are. The credit spread is a combination of two puts and two calls, where a put and a call that is sold is more expensive than a put or call that is bought. Okay, so with that, in this case here, you're looking at the 40-50, 40-40. So the 40-50 put is more expensive than the 40-40 put. Okay, and that's a vertical. It creates a vertical, and that's where you get your credit. Okay, that's how you get your credit. So 50 cents times 100, which is the multiplier, gives you $50. All right, and that's your trade. Now this is one contract. Okay, and so so that's how it works. So what you're doing is you're selling the 40-50 put and buying a 40-40 put. Okay, it does the same thing. Excuse me. It does the same thing on the call side, just in reverse. Okay. So the trade is considered to be a high probability trade, and the reason is for that because when you put on a trade, you don't have to excuse me, you don't have to be exactly right. As long as you're in a range between the calls and the puts, you're fine. And then you'll profit. You'll be able to profit from that. Excuse me, guys. Okay, so that range is actually the same as the max profit. All right. So once you put on that trade and you're selling an option, you get, in this case, 50 cents, $50, and that's your max gain. All right. So that's basically how it works. However, credit spread is there's a risk reward to credit spreads, and it's not good. Right. So you have to kind of take the good with the bad. All right. So this is how it works. So if you put on a 10 position, right, 10 contracts, you'll get the risk reward is $10,000 compared to $650. Risk reward is very, very bad. All right. However, the probability of making money is much, much higher. Okay. So your max loss in this case would be $9,350, which is also the margin requirement that you would need to put on this trade. Okay. All right. So if it goes max against you, right, that's the $9,350. However, I'm going to show you how you manage that so that never happens to you, to become a trader that has a max loss. Okay, that's really, really bad. All right, so let's talk about decay in options, because that's really important, because that's really one of the biggest edges that you have for trading credit spreads. And the reason is because the options decay over time. Okay, and so this is kind of how it works. So from 68 days to 33 days, the rate of decay is 34%. Excuse me. And from 33 days to 5 days, the rate of decay is 57%. And from 5 days to expiration, it is 100%. And so if you're trading a 70 TE, it's basically within 5 days, that expiration is moving very, very fast, right? The decay on that is going very quickly. Okay. And so that's why I really enjoyed trading 70 TEs and also 0 DTEs. All right. So probability factors, and let's talk about that. First of all, implied volatility. So the ideal setup in a market with the volatility is moving lower while in a trade. And so you want to have higher volatility when you put on that trade, and lower volatility when you close it, right? And that's what helps you. It doesn't always come that way, but that's what you want it to do. All right. So and just another part of this is that implied volatility it can be very, very strong, especially at the open of a market. Okay, so you want to put on, even a 70 TE, you want to put on that trade right when the market opens, typically, unless the market's going way, 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 way up. But the best way to put it on is when the market is kind of moving lower, and has a higher volatility. That's when you want to put that on, because it put on the put spread, because that really moves, it allowed you to move the market down, or the position down, and then let the market move up over time. And that's really the ideal scenario. It doesn't happen all the time, but that's what you want it to do. Okay, so theta, which is one of the Greeks, and we talked about that. It measures the rate of decline in the value of the option due to the passage of time. Okay, so another probability factor is market direction. And so if you put on a put spread and the market is moving higher, well, that's really good. That's perfect, basically. And when I put on a 70 TE trade, I like to put on the put spread first, excuse me, and then put on the call spread after the put spread has moved up in the channel, okay, in the range, all right, and then I'll put on the call spread. And the reason for that is because puts against the market are greater than calls in the market. So you get less resistance in the on the call side than you do on the put side, because typically when the market moves in one direction, it'll move harder down than going up. Okay, but you have to keep in mind that as the market goes up too, and we've had a lot of movement way up into the market, you can get crushed by call spreads as well. Okay, so you have to understand that, and that's why I like to put on the put spread first, let it move up a little bit, and then place the call spread afterward. All right. So we got that out of the way, and so let's talk about risk management and daily routines. So first of all, I always have a trade plan. Okay, so the excuse me, the trade plan should include entry, exit criteria, trade size, and composition when not to trade as well. All right. Number two, you want to determine when the max loss and your risk reward reward before entering a trade. So you want to be knowledgeable about anything that you do in a trade. Okay. Number three, trade no more than 20% of your credit margin based on total trading capital. Okay, leave room for drawdowns in case you need to adjust the trade. Okay, and that's why the 20% is very, very important. All right. You don't want to allow more than 2% loss, and a lot of times traders will use 1% instead of 2% in trading capital, so that you're in case as an example, basically using 10K, right, $10,000, and your loss would be $200, and that's really the right point as far as taking a loss. Okay, so for highly trending market, position your trades to follow the trend. There are exceptions to this guideline, but those require an understanding of market reversals, Fibonacci. Need to have a little more experience in understanding how you manage those trades. All right. And then, for example, if I place the 0 DTE trade today at 9:31, the implied volatility really works for you. okay? After that trade, basically from 9:30 to 9:50, the premium of that trade went from 60 cents to 15 cents, all right? And that's really a real-time example of how this works, okay? All right, so pre-market routine, review areas of support and resistance. I like to identify areas for shorter term trades to use them to determine how to adjust and how to get out, all right? Number two is review the dollar, typically because the dollar, as it moves up, basically there's a there's a counter to the market going down. Okay, so basically you want to have the dollar moving lower if you're bullish. Okay, and that typically happens. Review the treasury notes, and so again, if treasury notes are moving higher, or treasury notes are moving higher, or interest rates are moving higher, it creates competition with the market, and so you have to be cognizant of that as well. All right. I also like to review ES futures based on trending direction. With SPX, the SPX opens at 9:30 and it closes at 4 o'clock. But after that, futures take over. Okay, and it does make a big difference overnight and through the morning when that market goes in. So you could, most of the time the market either opens higher or lower, right? But never, most of the time it doesn't really connect. But you have, and that's why you have to be cognizant of looking at ES futures so that you know where that real trend is. Okay. All right. And then I like to review the VIX, which is the volatility index. And again, the higher the VIX, the better you have when you have the market moving in a direction that's far away. Okay. And with credit spreads, it's better to have positions that are further away from the market than they are close to the market. All right, and then determine the credit spread positions that you put on before you actually trade. All right, so let's go through the the strategy here. Okay. So here are the entry-exit guidelines. So when I put on a trade, I like to put on the trade between 1 and 10 minutes of the market opening. I use 10 wide trades because that's really, the sweet spot for me over time. Okay. And there's a lot of research that I've done of using that. Okay. I use a delta of 10 to 12 for the put spreads, and I use a delta of 8 to 10 for the call spreads. And that's because of what I said earlier, that that typically the if you have a premium that's exactly the same for each side, the call side is going to be lower or shorter for the market than the put side is. All right. Okay. All right. So let's talk about exits. I like to close the trade for 10 cents for each spread, and the reason I do like to do that is that if I'm doing a 7 DTE trade, typically what happens is that you'll get a very good profit between 7 days, but typically between 4 days that you get out. All right. So you want to instead of having the position go to expiration, it's better to do that, to just take a profit, close it out, and then put on a new trade. All right, so you have a lot of opportunity there to do that with the 7DTE trade. Taking profit for expiration is fine as well. A lot of traders will just leave it out there, won't close it, and then and basically it'll expire. I don't like to do that. I want it to be closed if it's closed, and move on. All right. All right, and also don't allow a profitable trade turn into an unprofitable trade. All right. So once you have a nice profit, you know, look around and you know, and take that profit and move on. All right. All right. So let's talk about adjustments as well. So when I adjust a trade, I like to do it. You know, if the market is threatening that trade, basically, I wait until 40 to 50 points, and then I'll roll that trade. Okay, so I can either roll it for another 7 days or 5 days, depending on how the market is. All right, so it's not a fast and hot, not a fast and perfect scenario, but in any case, you know, if you have profit, you know, take it and move on. However, if you are threatened with that trade, the best thing to do is roll it before it gets to a very, very threatened condition. So a lot of people will just wait until the end, you know, and then you won't get a great credit, or even if it's a debit, you know, when it's very, very close to the money. All right. So you wanna, you know, if it's getting close to the money, you want to roll it and move on. You're right, and that way it'll save you quite a bit. All right, and so exit and stop losses. Stop losses, I do use stop losses for call spreads, because typically when a market moves up and it's roaring, right, it's very, very difficult to get out of that trade on a call spread, and the reason is because the volatility is, you know, as the market's going up, typically the market's going up, volatility goes lower, and so there's less premium for you to manage it, and that way, you know, that way you can get into real trouble, and so it's better to just close the position and move on after several times of rolling it. All right, so I'm going to take you through, and I did this a while back, okay, and you know, markets do the same things over and over and over again, okay, and so I'm going to share with you, you know, a trade process for a month that I did. All right, and this is a real thing that I did, and it's very, very similar to what I do today. All right, okay, so this is between 9:15 and 10:10, so it's basically about a month that I went through this process. Okay, and during that month we had a 6.6% reversal here, and even though it doesn't seem like a lot, right? It's a lot when you're trading, and 6 points is pretty much, okay. It's quite a bit, and yeah, there's been times that I've gone through 10% corrections and 20%, you know, and it's not easy, it's not fun, you know, but they're often not, it's often not that frequent when you have those. But I wanted to share this because this is pretty much a position that went down quite a bit, and you have to manage it, and so you won't lose a lot of money. Okay. All right, so let's go through this. So first day here, I put on a put spread for 70 cents and a call spread for 70 cents. Okay, and then and so I received $1.40, you know, for this premium. After that, the market went down, and we closed that position. for 10 cents. And then I put on a put spread for 70 cents for that. And then I collected, basically the collection was $1.30 there, okay? All right, and now we rolled the trade down, and you can see here the market went way down, and so we widened that spread. Let me see, 44, yeah, 90, yeah, and didn't widen that spread. So we rolled it down, and we got a 40-cent credit on that position, okay? Right here, we got a call spread, so we put on a call spread on this. And then what we had then after that, we had 30 cents and 75 cents. And so that gave you $1.65 for that premium, okay? So it went up a little bit after we rolled it. Now we got a position here, call side that closed for 10 cents. We rolled this position, the put position, and received a 35 cents credit. And sometimes you can do that, okay? All right, so here now we put on a put spread for 65 cents and received overall $1.90. So now we rolled the position again for 5 cents or negative 5 cents, basically, a debit, small debit. And then we collected $1.10 for the call spread. And now we put on a put spread for 60 cents. And now we have $2.95. Okay, so you can see that premium, moving up, all right, in all the rolls that we were doing. So now we had a closed position for 15 cents. And then we put on a put spread for 60 cents. And now we have $2.08, basically. So now we rolled the trade here and received $1.10 for this position. And basically what we did is basically widened the spread here for that. Now you got to be careful with widening positions, okay? Because it can widen and then you're out of margin. So you have to be very careful with doing that. So what I like to do is I want to before the position is threatened, I'll get in there, and sometimes I'll just I'll have a debit and keep and not widen the spreads, so that I won't get into trouble. Okay, so you got to be cognizant of that. All right, so now we have 3.9 cents, 3.90 on this as we rolled it, and here we had a we put on a call spread here, and for 25 cents. And then we rolled the position for negative 15 cents, so debit of 15 cents. So now we're left with 45 premium and an 80 cent premium for this. And so now we have $3.50. So now it's getting close here to where we are. So so let's go through this again. So now we closed the position for 20 cents. And then we rolled the position for 40 cents. And you can see here we widened the position again. Okay. And now we have $1.95, all right, for those premiums. So now we have $3.70. So now we have here the close position for 30 cents and rolled the position here for 25 cents. Okay, so you can see the debits are not that large for what I'm doing, and it helps to widen these spreads. Okay, so you got to be careful with these as well, right? So here now we have we have a put at 70 cents and $3.15 here. Okay, so now we have the roll here, and we got it for 5 cents on that, and then we put on a new position, 65 cents. And so now we're ending up with $3.01, $3.10. And by October 10th, the last position actually expired. Okay, and we closed that trade altogether. So from the beginning we had $1.40, right? And now at the end you have $3.10. So so you can actually roll these positions for gains if you're managing them correctly. Okay, all right, so with that I want to share with you what we do. All right, so would you like to follow our trades while you learn using our short-term strategies like 0 DTE, 7 DTE, and become a consistently profitable trader? Of course you would, right? Anyone would. So when we first came in here, we were interested in learning new strategies, desire to grow our account, find the right strategy that provides consistent returns, and this is the place that you can get it. All right. So I've managed to work through a lot of different strategies, right, that works out with credit spreads, you know, and focused on that for many years, right? So the question is it time to break the barriers? Will you keep doing what you're doing and hope that one day it's going to stick, or are you going to finally take the steps to get to the place that you want to get to that really works? Okay, and it's not an easy thing. Okay, it takes work. Okay, it takes no quit attitude, commitment, discipline, and having an edge, right? And you know, many edges, right, to get through these positions. And so that's what leads you to success. All right, so we have a trade alert service that works really well, and I have it automated, right, for the most part. And so those signals come through very clear, and we have a you know, two different types of scenarios. One we have for two-way communication, and the other is just one-way communication, right? So so what we do here is we have two-way communication here where people are watching, looking, asking questions, and what to do. And so while you're making money, right, you're learning how to make these trades and how to do them correctly. Okay, and so and it takes experience to do that. It just does. So so we have great communication within the group, and we have live traders that trade for a living. We have, you know, I'm one of the traders, and then we have 3 other traders that are with us and are trading their strategies, and you have the opportunity to learn what they're doing. Okay, and so these channels here are one-way communication. Okay, so these are the signals. Okay, and they're very clear for getting the position that you want, and not having any errors. All right, and so we've really worked hard to make sure that works. Okay, so also we have a lot of different trade success stories. Okay, and so that you can you know, I'll share this with you, and you'll be able to see what they do and how they do it, and they're really been successful in what they did. Okay, so my guarantee: if you subscribe for 1 month and lose money by following my trades, I will refund your subscription by $1.25. Right? No, hands down. So we basically have 5 subscriptions. One is free. And people come in first and see what's going on, all right? And we share a few trades in there on a weekly basis. Typically, our normal pricing is $79, $1.19, $1.49, and $2.19. Okay, but if you're joining now, okay, which we're open now. Typically, we're not open all the time. We're basically closed for 3 months, and then we open for 2 weeks. Okay, so we're now in a position now that you can actually join at this time, right? After that, in another week or so, we're going to be closing the doors and focusing on the traders. And the reason we do that is two things. One is we don't want people just straggling in and asking questions all the time, at the same questions all the time. And the other reason is because when you go in there, you're focused and able to understand what we're talking about. And a lot of people will talk, and a lot of people will listen, and they become understandable. When we put this on. All right. And so in another week or so, we're going to close the doors and wait for and then we wait for 3 months, and then we open them again. Okay, and that's really how it is. But for now, it's open. That's the main thing. All right, so I'm going to give you this offer here. Let's see here. Okay, so you should be able to see it, and you have a process there that you'll be able to join if you want to for now, and then just remember, we're going to be closing the doors in about a week or so. Okay. All right. So let's see what I have. 4 more. Okay. So this is for you. If this is for you, you want to learn a step-by-step process to gain income in a market that goes up and down. You want to finally break the series of losses and account drains, right? And I was in that process for a long time. Okay, and you want to earn consistent income that sets you apart from other traders. This is it. Okay, so what you get and have access to is that you have $20 off for life. And we are currently open. Number 2, professional traders chat group and subscribers track group that we have. We have training and education channel, automated signals, as I mentioned to you before, and trade entry, fill price target after fill, adjustments, and my guarantee that you'll make money doing this. All right. And nobody has come back to me and said, hey, I didn't make money, it's never happened, because every single, now we do get losses. I mean, there's no question about it. But over time, with the number of strategies that we have, it's pretty much hedged, right? It comes through, and you're basically always making money. Okay. All right. So with that, I wanted to see if you had any questions about this. Let's see here. Okay. If you have any questions at all, 615 roll. Same numbers. I'm not sure what that means, Jim. The roll are the same. Oh, okay, yeah. So yeah, you have a number for the trade, and the number of times that it's rolled. Okay, and that's how that works. All right. Are there any other questions? That's odd that I only have one question here. All right. The 2 spreads are also an iron condor. That's correct. So when you have a call spread and a put spread, that is an iron condor together, and it allows you to have one margin for two positions. If it's in a different expiration, then you have to have enough margin for that. To do these spreads, I always say a minimum of $3,000, and if you're okay, more than that, $10,000 is really the sweet part. The sweet part of this position I'm sorry, for enough to manage these trades. So you don't have to be really tight in trading these. If the market is going against you, and why not convert the spread into a broken wing butterfly? Yes, a lot of people do that, but sometimes when you're at that point of doing that, and the market, if the market starts going, a lot of times it goes against you, and then you'll get a double whammy, right? Best thing to do for me is manage the trade, adjust it, and move on. That's what I do. All right. Any other questions? Stop loss is fine. I use, especially for 0 DTE, I use stop losses for call spreads, and I roll the put spreads. But with 7 DTE, you have enough time to be able to manage that trade, get it unthreatened basically, and move on, right? And you can actually make money as you roll those trades. But with 0 DTE, I don't like to I don't like to mess around with it, especially on the call side. The 0 DTE is, it's a little bit different. I like to let the positions expire, and the reason for that is because a lot of guys don't have $25,000 to cut, for 0 DTE, and that's what you need in order to not be restricted. And so, but it's similar. It's similar to 0 DTE is similar to 7 DTE. It's just, and I call it, the monthly trade on steroids for 7 DTE. So I love monthly trades. They're very calm, and but with 7 DTE, you get a lot more profit, obviously, because you're constantly moving. All right. Anything else? All right, guys. I think we're good. Oh, wait. When you roll a trade and open a new trade, always require credit? No. Sometimes I use debits for that. That's just part of trading and taking losses, because a lot of times you want to, if you get really threatened, right? You want to be able to allow that to get over and close that trade. So sometimes we do take losses on those trades, and that's how it works basically. I don't cut a position that's all the way in the money, but I tend to roll it and manage it, and yes, you're going to get losses on those positions, but over time, you're going to be profitable on these trades. Yes, we are going to be providing a replay on this webinar. Okay. All right. Okay, guys, I think that's it. And if you have any questions, you could email me, and I'll be around. And hopefully I'll see you in the trailer service. All right. All right, guys. Thanks, and have a great night. All right. Thanks, guys. And hopefully you've taken value on this, and hopefully you'll make money on it. And if you need any help, I'll support you and work with you, and hopefully you can be a great trader. All right. All right, guys, thanks, and have a great night, and we'll see you.